Time now for this week's quote of the week. I was thinking that Peggy Noonan is, I was going to say, one of the most esteemed writers on politics in America. I'm thinking about it. I don't read political writers, so that may not be fair. There may be a whole bunch of genius that sprouted up in the last year. Most of the time, I just find it a complete waste of time for me. She worked in the Reagan White House and now writes for the Wall Street Journal. She is the exception. As I say, for my money, she's the most insightful political commentator in America. And if you want to understand what's going on in American politics, listen to this, in quotes. The Washington area is now the wealthiest in the nation. No matter how bad the hinterlands do, it's good for government and those who live off it. The country is well aware. It's no accident that in the national imagination, Washington is the shallow and corrupt capital in the Hunger Games, the celebrity-clogged White House Correspondents' Dinner scandal, and the green room at MSNBC. It's the chattering capital of a nation. It less represents than dominates. End of quote. I think that sums it up beautifully. And I still say the media is part of the problem in general. I know it's a generalization, but the mainstream media still hasn't figured out why the backlash against the establishment. Well, she just summed it up. The establishment doesn't represent, it dominates. Let's get to the subject of gold. Let's get to the subject of the breakout industry of the week. Who better to chat with than Mark Leibovit? Mark Leibovit is been Timer's Digest Timer of the Year, long-term Timer of the Year, and I'm going to start with his reputation as Gold Timer of the Year. Mark, thanks for taking the time.
Thank you for having me back, Michael. Always a pleasure. Thank you.
Well, more a pleasure for me and the audience. You must be having the hair on the back of your neck stand up when you look at all the action in the gold market, people phoning you saying, Mark, what's going on here? And I'm going to be no different. Mark, what's going on here?
Okay, Mike. Well, I was looking for a correction. We sold our gold stocks and our gold play several weeks ago looking for a correction, and here we have it. So we were looking for a pullback anywhere from 1220 to 1270. We got to 1241, I believe, on Friday. So we're in that area. In fact, we turned up after that low on Friday. So if we get some volume confirmation come Monday or Tuesday, maybe that was the bottom. We'll see, but we're definitely in that buy range. And my overall strategy was to exit, get back in for play now up through the 1375 high up to the mid 1400s. I'm hoping by the end of the year, but maybe into the first quarter. So of course, a lot has to do with the election and so many variables around the world. You know, we had that flash crash in the British pound Friday morning. We had all kinds of interesting things going on around the world, so a lot of things could trigger it, but that's what the charts say.
You've been Gold Timer, Timer's Digest Gold Timer of the Year. I suspect, given I was well aware of your call in September to say, hey, we're about to take a significant rest, take a break from the gold stocks, take a break from the bullion, and as I say, I suspect you're going to be right back there on that list by the time we finish this year. Mark, you just mentioned some of the variables. What are your sort of trading parameters here? As you say, you had a 1240, 1270 kind of range on it. If we break down, do you have a breakdown number to tell you that the correction may be more harsh?
Well, I guess if we take out 1210, that would start to worry me, and then the next big support number is around that 1175 area. I'm willing to live with it down to, I guess, 1175, and unless something really dramatic changes in the technicals. I think a lot of this is just part and parcel to a normal correction. In fact, a lot of bearish sentiment out there, a lot of discussion how the gold rally is over. I'm a pragmatist. I mean, ultimately, I have to admit I'm wrong at some point. So, but at the moment, this is sort of a predicted event. And like I mentioned a moment ago, I still like to see some upside confirmation here. I like the fact that we reversed off a low on Friday. That was nice. And but the confirmation would come if we got some follow through early next week on upside volume. So if we don't get that, then I'm already in there. We start to do a little nibbling here as well, but I would probably wait until we had some further confirmation of the bottom, and that would come with my what I call volume reversals. Positive volume to the upside in the shares and in the metal futures. So let's see if that unfolds. But I think we're definitely in a time band and a price band to be looking at gold again.
It's must give you further. A lot of times models get into sync with a market. methodologies. So it must give you some confidence, given that you had predicted this kind of a downturn to these kinds of numbers. It would seem to me to lend a little credence that the models you're using are in touch with this market.
Yeah, I just try to turn off the noise, Michael. I'm just looking at the chart. It was expected, but like I said a moment ago, you got to get confirmation of your prediction. So we had a confirmation of a top. It did come down. In fact, for a very short time, we were actually short gold. We were playing the inverse ETF for a short period of time just to catch a little bit of the downdraft. But now that we're down here, I'm just waiting for some confirmed signal. So that's pretty much it. Pretty simple. We're already nibbling in there. We're in there. Let's see if we get some further confirmation. And I'm pretty confident with all the turmoil in the world. There's so much going on. We can spend an hour on the phone here going over all the problems around the world. I mean, there's all kinds of stuff, everything from worrying what Putin's going to do to, what Yellen's going to do or not do in December. So I think there's a lot of triggers that could take gold higher.
By the way, I don't get the impression, I don't have the data, but I don't get the impression that the Canadian public is aware enough of the kind of tension that's been escalating between the U.S. and Russia over Syria. Announcement yesterday, for example, that Russia has made an agreement to have a permanent base in Syria. The U.S., coming back with John Kerry's statements yesterday, I believe it was, again, outlining the threat that Russia's posing geopolitically. And as you say, that may well have an impact, but I don't get the impression that Canadians are well aware of that.
Well, hopefully we'll get more input on that. One of my good friends, Bill Koenig, who I quote quite a bit in my newsletter, he's a White House correspondent, and he had a little blurb in his newsletter yesterday about, hasn't been confirmed yet, but some Russian submarines were apparently seen off the east coast of the U.S., so, in fact, that it came from him. I'm giving it some credence that there were some rumors floating around the White House or in his vicinity. So there's things happening. Could be very interesting. I admire Putin because he stands for his principles, but at the same time, there is that potential conflict between us. No question about it.
Mark Liebovit is my guest. You can find it at vrtrader.com, but you can go to Liebovit News, Liebovit VRnewsletters.com. There you go.
It's easier just to go to vrtrader.com. That's easier.
Yeah, that's what I was going to say. I'm going to vrtrader.com for that because there's a lot there. But Mark, I got to take a break before I don't want to short changes because there's something else that you were the pioneer. You and Jim Dines are the only two guys I know going back several years at the World Outlook Conference. You made it very clear. I asked you specifically on the stage, what do you think will be the biggest surprise going forward in the equities? And you said you thought the marijuana stocks, and I had not heard that before. Our audience hadn't heard that before. Well, we had a major breakout this past week in several areas, and here's a teaser. It was thanks to Snoop Dogg. I'll talk to Mark Leibovit about that when we come back right here on the Money Talks Network. I'm talking with the Timers Digest Timer of the Year, former long-term Timer of the Year, and Gold Market Timer of the Year. They don't have a marijuana Timer of the Year, but you'd get that, Mark, if they were doing it at Timers Digest.
Okay, I hope so. Thank you.
Well, let's go to that. You were, as I say, very early days. You were talking about the trend toward legalization of marijuana, looking at the stocks that were serviced. You warned people that this was a very new industry, so there's going to be a lot of shakeout in it. Are we any further along now, Mark, than we were even 2 years ago at sort of picking out industry leaders, or is it still that level of speculation because it's such a new industry?
Well, it was easy in terms of the Canadian names because these were really the leaders, and the fact that the legal environment is so much more conducive in Canada versus the U.S., so it was really easier picking the names like Canopy and a whole list here. We can go over those. They've been doing really well for us here. But you had to be patient. They've had their swings. But I think this current push to the upside, I know it doesn't sound like it should connect or not, but the elections in the U.S. Come in 30 days, with California, Arizona, and a few other states possibly legalizing recreational. Of course, in Canada, that's pending with Trudeau's proposal as well. But I think the U.S. election has added a little bit of an impetus here as well to the interest in the marijuana space. So, again, it was easier for Canada, and I think much of the push, really the issue for many of the companies, as you know, is revenues, but are they making money? And in most instances, there aren't many profits to talk about yet, but, they're all on the cusp of doing that, and, the market always anticipates the future. But the easier names to play, in truth, have been the Canadian names. They were showing more relative strength, and and we had a whole bunch of those. And I should also say to your listeners, we rang the register last week because, not to say I'm bearish on them, but we had some huge gains, in some of the stocks. So, a name like Canopy, that I think we paid about $2 for, went up to $4.40. I mean, it doubled. I mean, those kind of plays are awfully attractive if you're taking a trading perspective. And I always try to do that. I try to put out that long-term idea, and we can trade it all the way up. But when you double your money, in some instances triple your money on this stuff, particularly as the investors are jumping in anticipating a positive event, like I say with the election, to me it was a reasonable speculation to take some money off the table here. But we're looking to get back in, so stay tuned.
Of course, you produced the Vice newsletter that covers a wide variety, but it was centered on your idea about the marijuana stocks. I mentioned a moment ago that Snoop Dogg seemed to be the impetus for something like Canopy to really take a jump up. I forget what he's even doing. I mean, Snoop Dogg is no stranger to marijuana.
Right, lending his name to the products. I don't think that was a news story. I thought that had been out for a while, but I heard a lot of celebrities are tying their name to it, whether that's going to help the sales of the products or not. There's a big marijuana convention coming up, actually, in mid-November that I've attended in 2 previous years at the Rio Hotel. It's like the big event, and thousands of people show up, and all the products and companies are there. So I may, for me, I'm based in Phoenix. It's a short drive up there. I'm definitely going to go up and just sort of snoop around. Maybe I'll find Snoop Dogg.
Yeah, exactly. It's just so hard not to be joking about that. It's been a great, as I say, you've led people in from your subscriber base through the Vice letter, into all sorts of fascinating situations. I really loved your theme right away. You said, I'm not sure about the sellers, but I'd love to be part of the supply chain there, because no matter what, they make money, even if the company they sell to in terms of the paraphernalia, in terms of growing and all that stuff, doesn't work out. They've already made their sale. So those companies, is there a leader in that side of the business?
Well, I would say, I would stick with the two blue chips that I like, across the border, going across the U.S. and Canada. I would stick with Canopy. I think that's the blue chip in Canada, and of course my big favorite, as you probably know, is GW Pharmaceutical, GWPH. We've been so successful with the stock, it sort of distorts reality. I mean, we were buying the stock within the last 6 months in the 30s, and it opened up $80 3 days later after we bought it, made 50 points overnight, and we've been trying to trade this thing all the way up. Now it's around $135, and it's going to be bought out. I mean, it's the leading medical marijuana play in the world. They're based in UK. The price sort of tells you what's happening. So some big pharmaceutical company is going to come in there and buy it. So I would suggest, with the trend of where it is internationally, any pullback in GW, I say it's pretty expensive here, around 130. But if it can drop 10 or 20 points, I would definitely take a look at that. I mean, it's probably going to be a $300 stock in the next 3 years if the trend continues.
That's the Vice newsletter, and you can get that at vrtrader.com. Mark, let me shift back to the overall market right now. You mentioned, of course, as we're all focusing on the U.S. presidential election because it's such a different year. If there's anything that people can give Donald Trump tremendous credit for is he's raised the interest. It started right with the primaries, right with those GOP debates, now into the public debate. I mean, you look at the ratings, 85 million people or so watched that first debate. The second one is tomorrow night. But let's talk stocks in that side of things. Is this adding an air of uncertainty to the market, or you just ignore that and just watch what the charts are telling you?
Well, this is really exciting. There's a lot of stuff to talk about here. The conventional wisdom states that should Clinton win, then we have a big global rally. If that happens, I'm going to be on the short side because I think it'll be sort of a dream scenario here, a big spike up, and then I think fundamentals are going to set in, particularly with the risk of the Fed raising rates in December. On the other hand, should Trump win, which I'm sort of betting on, the market's going to probably take a nosedive right away because Wall Street's got this misconception that it's bad for stocks if Trump gets in, and we'll talk about that in a moment. At that time, I would be a buyer of stocks if there was a sharp sell-off on his victory, and gold will probably run up $50 or $100 an ounce probably on that event. So if you're positioned, you'll probably make money in gold. So the basic view I have, though, you and I would probably agree on this. We've been around a long time. It really doesn't make a lot of difference who sits in the White House in terms of what the stock market does. I mean, that's really the long-term truth. You know, you go back and see what stocks have done under Republican and Democratic administrations. There's always trading opportunities. So my life and career is not going to depend on who wins in November, though I have other political and social reasons why I would favor one candidate over another. You know, it really doesn't make a heck of a lot of difference, and it's going to provide some great trading opportunities for us, like I just mentioned. So I'm sort of, keeping a lower profile here, and maybe we'll get some signals prior to the actual election day about taking in more positions, but I'm not going to defer from my comment on gold. I'll still be buying that. And as far as stocks are concerned, we may have to wait for the election results in terms of taking that big trade, going short, like I said, on a big rally if Clinton gets in, or buying a big dip if Trump gets in.
Well, it's also, you just alluded to it, it seems that central bankers have taken front and center stage far more than politicians. Yeah, there's the drama and the gossip, and there's everything about the politics side this year in the U.S. election. But beyond that, it's the Federal Reserve that seems to be dominating. I mean, that's what.
Right. It's a worldwide rigged market. We've been talking about this for a long time in my letter. I mean, you've got the look at Japan. I mean, I think Japan owns pieces of 70% of the stocks on the Japanese exchange. You've got the Draghi out there buying corporate bonds. He was talking about buying stocks, but he hasn't done it yet. And even Yellen's talking about buying U.S. stocks. I mean, to do whatever they can to support the markets, keep interest rates low, and whether Yellen goes up a quarter point or not doesn't change the fact the rest of the world is sitting in negative interest rates. And ultimately, I think the U.S. will go to negative interest rates. So it's probably good for stocks, whether it'll last forever and how high are we going to go. I mean, there's going to be a bubble here at some point, and hopefully we can take advantage of it. I'm sort of proud of the fact that I've never been caught in a market crash in all the years that I've been in the business. And if one is really coming, Michael, I'm going to catch it, or at least have some warning that something is coming. So just about every, including the Brexit decline we just had, a lot of the recent sell-offs, the flash crash, I was out of the market or short, or saw volume come into the downside, warning of that. So if we're going to go to 40,000 in the Dow and have a big bubble, fine, but I'll be out before the big crash comes.
And I'm glad you're bringing that up, because the track record of VR Forecaster, VR Gold, that kind of stuff from the VRTrader.com has been exceptional. I remember very specifically on this show, you warned us that there was going to be a very sharp, strong downward move, and that was just before the flash crash. That's just one example, I know. But just very quickly, Mark, because we've only got about 40 seconds left here. That's the key, it would seem to me, that to use your methodology to avoid any sharp downturn and be prepared if we go up.
I'm always watching the volume. As long as that volume is there, you're watching the smart money, the insiders moving, the big institutions moving, and you see it in the gold market, you see it in the currencies, you see it in stocks, and that's really what tries to keep me intellectually honest here over the years. I do have my prejudices, and no question about it. I'm not perfect, but I try to stay honest to what the signals are telling you.
Well, great stuff as always, Mark. Fascinating to talk with you. I invite people to go to VRTrader.com. Back with my shocking stat. A reminder, you can get an update on Money Talks every single day if you go to moneytalks.net. Lots of great articles up there. I just hope you join us on Money Talks or Michael Campbell's Facebook page and the Twitter account, all of that. Start taking advantage of it. Things are changing in the world. Time now for this week's shocking stat. I have two shocking stats this week, and let's start with the shocker from the world of entertainment. This is according to The Economist magazine. In 2015, vinyl record sales were the highest since 1988. That's the 10th straight year of increases. Did you see that one coming? Vinyl record sales, the highest since 1988. 416 million worth sold. A little bit more. Aside from the iPhone, the biggest selling audio device was the turntable. Not hand-free headphones or Bluetooth speakers. It was the turntable. And here's the other side of it. As The Economist points out, it's not nostalgia driving this. Nearly half of the vinyl buyers are 35 or younger. And 45 to 50-year-olds, 55-year-olds, that's only 18% of sales. So over half of the vinyl record buyers are 35 or younger. I'll tell you, when I read that one, I was shocked. I never saw that coming. Someone would have made a lot of money betting me on that vinyl record sales were the highest since 1988. Let's move to the world of finance. This is another shocking stat, unfortunately a lot more serious. The International Monetary Fund released its latest fiscal monitor report this week, and the global debt of the non-financial sector, that comprises things like general government, households, non-financial firms, is currently at an all-time high, $152 trillion. That's 225% of the world GDP. Debt growth has vastly outpaced the rate of economic growth. That's the thing to get, which says their whole strategy of, hey, let's have record low rates, let's have quantitative easing, let's even buy stocks if you're a central government. It hasn't worked. We're getting less bang for every dollar borrowed. Think about that in terms of the Canadian context, because we have such a general view. The narrative is that the government should be borrowing to boost the economy. Well, they've been borrowing. It has not been boosted. They are doing the wrong thing here, largely thanks to record low rates, which are actually deflationary in a deflationary environment. The IMF warns that 2/3, amounting to $100 trillion, consists of liabilities of the private sector, and you've seen that a lot. That carries a heck of a lot of risk. There are concerns about the sheer size of the debt, could set the stage for an unprecedented deleveraging process that we're in right now. And if that happens, you're into a really semi-period of low growth. This is a fragile economic recovery, and it's very clear. The research has shown that high debt levels are linked with lower growth, even if a crisis is avoided. I mentioned earlier off the top, Canada now, you take all of our debt in Canada, it's 290% of GDP. That's worse than Italy. This is not a casual subject. We are in the debt unraveling now, and it's only going to get worse. I'll take a break. I'll come back. Aussie Jurors got a new forecast in light of the new mortgage rules. I'll get to all the consequences of those rules right here across the Money Talks Network. Mortgage rules were announced by the federal government on Monday. I think it's a game changer. I think it has a tremendous impact on both the mortgage industry and on especially first-time buyers on low equity mortgage or transactions. Plus, anyone else who needs an insured mortgage is just qualified for less. Aussie Jurek joins me on the line now. Aussie, let's get through a lot of this thing. I want to talk about consequences of this. The details basically are straightforward. There's a lot of ramifications, but in a nutshell, I'd suggest that this is the detail. It's the equivalent of raising mortgage rates by 2%, from 2.5 to 4.64 de facto, because that's the mortgage you qualify for right now. You've got to not go off of the negotiated rate. You've got to go off of eligibility as if it was 4.64. Certainly that took the industry by surprise.
Yeah, and if it's an insured mortgage, right? But the real thing is the totality of it. I mean, the changes are wide-ranging. They're sudden. It's almost like it's been planned as a let's really make sure the mortgage market is hammering down the housing market. I mean, if you had before an income of $60,000 with 5% down payment, you experience a reduction of purchasing power from $380,000 to $305,000, because this is really the key, Mike. While they're trying to hit us in Toronto and Vancouver, and maybe rightly so, it's sad that the borrowers in the majority of the country are clearly paying the price because they're not having a runaway market. They want to buy that $400,000 house. Now they can't because they need much more down payment. And the impact will be that in some of the no bank lenders are saying it might be as much as 40% of the buyer population is going to be taken out of the market. And if you think that is not enormous, remember, you can't sell your house if you don't have a first-time buyer in yours, and you won't buy the third buyer. All the way up, it will have a ripple effect on the market that is going to be much more negative than people realize.
I agree. I said that off the top. When you're looking at the broad economic impact, this is the one industry we can't afford to slow down. They have now purposely slowed down. Finance department says it's going to result in 8% lower sales. I think they're underestimating it. But let's come to one of the other things that's big, is that you've chronicled on this show very clearly that the Vancouver market, if that's one of the targets, had peaked in April.
Yeah.
So we're talking about, and certainly somebody in Edmonton and Calgary is saying to me today, no kidding, Mike. Their market's peaked has been in a downturn far longer than that. So this is a real kick at a time when maybe the measure wasn't needed. And we don't have some default problem in mortgages in this country.
Well, that's the crazy thing. Here we go after the first-time buyer. You said it so rightly, and I have that as a headline. We talk affordability, which is really misleading because the very people that we're supposed to make it easier to afford, it's worse for them. It's not just worse. They can't get the money, number one. Number two, they can't qualify for the mortgage, and it's a lot more expensive in terms of the insurance that they have to pay. And so it's all along, it is totally misleading. I think under the foreign buyer umbrella, let's get the foreign buyer. We're going to bring in everything we always wanted to bring in, and they have. I mean, it's one shoe after another dropped all week long.
Yeah, and I'm proud of the fact that we've been talking about this. I tell you, 10 minutes after these rules, I wrote the business comment for the following morning, and I can't believe how long it's taken the general media to pick up on the fact that this is a direct attack on a lot of first-time buyers and on the mortgage industry itself. I don't think the media's figured that one out. We're talking about a huge hit to anyone who's a non-bank lender.
Yeah, I call it it's an early Christmas present for the 6 big banks. It's a kick in the teeth for all the lenders, and because when you take a look at it, you take Genworth, for instance, which is an insurer, but a private insurer, just like CMHC. Their stock dropped 14% in a day. People that are in the market realize they're going to do one heck of a lot less business. And it's not just that lender. All the off-center lenders, they can no longer do the business because by the new rules, they will have 40%, maybe as much as 40% lower amount of business. The people then will go to the banks. The banks will take that extra business, but at a much higher price and charge to the buyer. And here what I'm saying to mortgage brokers, you may very well be kicked out by one of the banks or even two of the banks, because if they have more business, they may not need you. So be very nice to your friendly bank if you're a mortgage broker.
Let's talk prices for a second, Ozzie. First of all, it's going to, I think the market's going to take, a year and a half to digest these changes. But right now, as you say, with people qualifying, if they need an insured mortgage and they're qualifying for less, even if they put more than 20% down, well, we're going to get a stall in the market, or sellers are going to have to lower their prices. It's going to be one or the other.
No question, and certainly in Vancouver that has been the case already. And we said on the show last week and the week before that year over year we still look good on the price. But if you go April till now, we are already down between 4 and 11% in different suburbs in Vancouver. And so the thing is, we said we saw an across-the-board year-over-year increase would be recorded at year-end of 10%. We're now looking at that to be as much as 20%. But it's not just because we're looking at different areas, at different market mixes and different. But overall, I think it will have a much bigger impact than we originally had thought.
Well, I'm just thinking of the people in the real estate industry in Calgary, Edmonton, other parts of Alberta, Red Deal, wherever you've got into Saskatoon, they are not in a strong market right now, of course, because of other factors. But my goodness, this must feel like a hell of a kick in the teeth for all of those centers that are not named Vancouver and Toronto, basically.
Exactly. What are they thinking? The market, we're looking at Edmonton, one of the nicest places in the world to live. The average price for a nice single-family home is around $450,000. And before the 17th, I could relatively easily, with my 5% down payment, I could get maybe a mortgage of $380. Now I only get $305. So what's going to be? I'm going to either back off as a buyer, or the owner has to reduce the price in already a slow market. It hits all these markets that it shouldn't be hitting. Why should you make a national policy like that? It's almost like, I know it sounds stupid, but it's almost like a conspiracy. Let's bring this in. The other thing, of course, under the umbrella of getting all the capital gains in, one of the big things is that it's literally a game changer. You have to now report your principal residence on your tax return every year, whether you sell or not. And you got to make sure that you understand you have a single-family home, but you have a basement suite. Well, guess what? If you sell your house, that basement suite will now have to be deducted from your profit. And let's say you had $1 million gain, you have to declare 50% of that. And it might cost you $50,000. The tax grab is immense. And in the middle of all that, West Vancouver goes and brings in a speculation tax. That's after only 13 single-family homes sold in September this year versus 77 last year. It's the horse is dashing down the road since April, and we're now really closing the door tight.
And by the way, I'm going to say, and again, I talk about what our track record here is for a good reason, because this isn't politics. You know, we're not talking about choosing a TV show. We're talking about if you have the right methodology, it will show itself, as Mark Leibovit just did in predicting the current 1 month decline in gold. His methodology called it. You know, our methodology has been very clear, calling the drop in the Canadian dollar, calling the drop in the oil and other resource prices, calling where the economy is going, in other words, nowhere, calling interest rates. All of that is because we have the right methodology. And when I look at what's happened in government, your example about West Vancouver is an exceptional one. I mean, talk about not understanding the dynamics of the market. And to put in something this late in the game, to me, is absolutely head-shaking and a testimonial to their ignorance about how markets work.
Yeah, I should hasten to add, it hasn't been approved yet, but it's on the agenda. And there's a whole bunch of, I mean, look.
Well, fair enough, but I mean, it shouldn't be approved at this point. Where were you 3 years ago, for goodness sakes?
Yeah, I mean, and when you look at the vacant house tax and all of the taxes, right now we are assembling all of the taxes that we have now in the housing market. Maybe we can make that a subject next week, but it opens your eyes. We're talking hundreds of millions of dollars in a market that you're very concerned about, that we may have a recession. In fact, this move may bring on a recession faster than we thought. So, my goodness gracious, we have to take a deep breath and realize we still live in paradise, and the world will go on, and we'll come through this too, but it's a little darker than it was last week.
Well, I'll tell you, when you jeopardize people's employment, I get vexed about it. You know, one of the most tragic things you can do to a family is to manufacture a job loss, and that's what this is. This isn't because somebody did something in Europe, if you know what I mean. You know, we don't set oil prices, so we've had the devastation there. We don't set, we don't determine exactly how many exports of our exports the U.S. buys. But this is something that we had in our control, and I think it's misguided, and it's ill-timed, to say the least. Ozzy, we got so much to talk about. I'll look forward to more, and go to Jurok.com. He'll be giving you constant updates there.
Thanks for having me, Mike. Have a good weekend. Have a nice holiday weekend.
Not anymore now. Happy Thanksgiving to everybody.
Yes, happy Thanksgiving indeed.
I'll take a break. I'll go live to the trading desk, and I got to goof. I hope you're going to have a tremendous Thanksgiving dinner, a weekend, a chance to, hopefully a chance for many to get together with friends or family on this Thanksgiving weekend. Victor Adair joins me live from the trading desk now. Vic, let me throw you a curveball and start with this, because we were talking about it and alluding to it with Mark Leibovit. How are the markets pricing the presidential election?
Hillary wins.
Oh, okay. There, in a nutshell, Hillary's going to win. Is it overwhelming? Is it slight, or what?
I'd say at the moment, the pricing in the market is she is going to win, and it's going to be a significant or a real victory.
Yeah. And let me throw to the Federal Reserve. I was talking to Mark that how important the central banks have been. What's the market saying right now about an interest rate hike in December?
65 to 70% chance that they will raise rates by 1/4 point in December.
Interesting stuff. Let's get to what you're doing in the markets right now. The bottom line, given the presidential election, then you weigh that against the Federal Reserve. Where do you stand on the U.S. dollar?
We're 5 years into a bull market in the U.S. dollar. I've maintained long positions in the U.S. dollar here. I am long of the U.S. dollar index against a basket of currencies. I'm also net short of the Canadian dollar, the euro dollar, and the Australian dollar. I'm looking for the U.S. dollar to keep going higher. With the Canadian in particular, we closed at a 6-month low here this week. Canada in the last week or so was unable to get any lift from this 16% rally we had in WTI, which normally you would have thought Canada would do better. I think if crude starts to slip back lower here, and I do think it will, that'll put more pressure on Canada. And in conjunction with what you and Ozzy were saying about the possible slowdown in the construction real estate market we've seen in Canada, I think we could see Canada below 70 cents if that comes to play.
Yeah, I think it's a great point you're making about when you watch how a market reacts to a piece that was otherwise very good news for the Canadian, which would be the rise in oil, and yet it didn't react. I think that's a big negative also. But I got to get two more in on you here, Vic. What's your position on crude? I know that you were establishing short positions when it was around $49, $50, going back a month and a half. Where do you stand now as it pounds above 50?
The crude oil market, we were getting short mid-August. Prices dropped down to around $44 at that time. I thought we'd see crude continue lower below $40. We had the surprise announcement from OPEC, and that plus some declines in American inventories, perhaps also some input from the fear of the hurricanes, has taken gold, WTI back above $50. We've used the rally above $50 to add to our short positions. We think WTI goes lower.
And what about gold? You must have been really happy. I know that you've been short gold. You've told us on this program around the 1350 mark. You must have been happy with this drop. Have you closed out that position, or are you still looking for more weakness?
We've been short gold because we saw a massive buildup of speculative long, like buyers, when gold rose from the December lows up into the July highs. Like paper gold, long positions on COMEX were the largest ever in history. And I thought the market was vulnerable. And once we broke through $1,300 here earlier this week, gold's down 9 days in a row. We've got some price points, and I think if it continues to work lower, we'll have more selling. We've seen maybe 20% of those speculative long positions liquidated. I think the market is still vulnerable, so we remain short.
You're going to have a happy. You've had a very good week in these markets. You're going to have a happy Thanksgiving. Go out and have one, Vic.
Mike, you too. Best wishes to you and your family for a great weekend.
My pleasure. Thanks to Vic. Thanks to all our guests. Time now for this week's Goofy Award. To remind you that Money Talks is brought to you by Solera Club. Solera Club is a royalty-based investment. There are no fees attached to it. It is in the tech sector. Go to soleraclub.com. Thanks to the Ottawa Citizen for this. There's always accusations of political bias in various institutions, from the mainstream media to academia, but rarely does a group own up to it so publicly. The group in question, Canadian studies professors who slam Stephen Harper's Conservative government so often that they're not sure what to do without him. After all, Prime Minister Trudeau's Liberals are part of the self-described progressive left. And what are they to do when the Liberals adopt Mr. Harper's climate change goals, or they've adopted the healthcare transfer formula? So what to do? The Canadian studies professor are holding a conference to discuss their dilemma called After the Deluge, Reframing Sustaining Critique in the Post-Harper Canada. It's at Carleton University at the end of the month. The question is, what do we do now? What to do indeed. How about getting over yourselves and your personal agenda? Serve the people of Canada, not your political agenda. Thanks for listening. Go out and have a merry Thanksgiving.